Thank you for joining. It's a pleasure to have all of you here. We will start in just a moment. My background is a physician who went to business school and a management consultant working with firms like Accenture and Deloitte. I was consulting for primarily payer organizations like United, Aetna, and several Blue Cross organizations, and also providers like Vanderbilt and Duke University Health. Travel got to me, and that's when I thought I need to do something which does not involve that much travel. And that's when I started Care Ventures Capital, which is a private equity firm which is based out of Houston. And we primarily invest the multifamily asset class, and we have some investments in farmland as well. Right now, I have ownership in 500 units as general partner and limited partner, and about close to 1,200 doors as owner operator. And so when I say owner operator, it means that I'm actively involved in the day-to-day management of this. So many of the people you meet, especially a lot of the physician friends who are raising capital, they do this part-time, but yeah, I do this full-time. And that's kind of what we do at Care Ventures Capital. Right now, we have about 100 million assets under management. And also, I work with a partnership who has ownership of about 3 billion assets under management. So that gives me a lot of experience in dealing with sometimes about what to do and even what not to do. So that's the other thing I bring to the table. And then we have assets across Texas, Georgia, Oklahoma, and Florida. So that's just a little bit about me. And then any of our presentations start with a disclaimer because it's mandated by SEC that people just don't come in and provide advice on stocks, bonds, or any investment without having the right skill sets. So if you ask me, I'm not the person to provide any advice on legal or tax matters. And you should always consult your CPA and legal folks before taking on any investment. Okay. So we'll jump right in. What I thought I would start with is to put together a framework of investment evaluation. So I sat down and thought about how I evaluate an investment. And when I say investment, I'm talking at the highest level as an asset class. So I'm not talking about an individual home or individual single family or a short-term residence or a apartment. I'm talking about multifamily as an asset class, short-term rental as an asset class, single family as an asset class. And then some of the very new and interesting projects that I'm involved in right now is a 7,700 acre project. It's a township development in Louisiana, right? So, and then there's something else that came from Puerto Rico, which is part of the entire electrical grid in Puerto Rico being revamped, and FEMA is funding that, and there's some projects around that. So I wanted to come up with a sort of a generic framework so that can be applied irrespective of the asset class. So this is not where we are going into the detail of a specific apartment or a single family, just a higher level. The next one, and in the next couple of slides, we will talk about evaluating more of a real estate market and drilling down a little further. But here, I call this in our management world, we live with a lot of frameworks so that it's all standardized and easy for everyone to understand. So I put together what I call the 3 O's investment evaluation framework. So it's just basically 3 parts to this. One is the owner, which is you, the future owner, and then next is the opportunity itself, and then in cases where you're dependent on a third party. So if it is in a passive investment, a lot of you are involved as investors in apartments, for instance, you are dependent on the operator. So the operator also becomes really key in the whole process. So that's kind of the 3 pieces to this puzzle in terms of evaluating an investment. So we'll start with the first piece here is the why, right? It just people want to invest, but we need to understand why we are investing. Is it get some free time from investment so that you don't have to work like 7 days a week? Is it to diversify your portfolio because of anything else? Or is it just because your neighbor is investing in X, Y, and Z, right? So we really need to figure out why. right? And what we are seeing more and more is that a lot of physicians are either quitting their job or moving part-time. So last year just came in today, 100 last year, 115,000 physicians. That's a big number. And again, about 53,000 nursing practitioners also quit practicing medicine last year. So that's a big trend going on because you really need to understand why. So that's one big question that the owner or you have to figure out. The second is time, right? Do you have the time? And how much time do you have? So if you are like starting out right now, some of the folks coming into the world of investment early on, I'm assuming they have much more time than some of the people who have a family and kids and all that. So then your time you might not have as much time as the others. And then if you are a single mom with 5 kids, that's a scenario, or a single parent with 5 kids, you should not be doing a short-term rental, things like that. So you need to understand how much time you have. So in my case, I'm sort of semi-retired. So I have the time. I can spend a lot of time doing all the research that is needed and putting in those hours and being hands-on when needed and spending the time involved, the time needed to operate an asset if that's needed. And then, so the phase of life also becomes important because depending on that, some of the decisions could be different, right? If you are starting out early and you have a longer horizon of investment, then you are more prone to taking a little more risk in your investments because a little more higher risk gives you a little more return. And then even if there is a little bit of a loss, you have the time to make it up. That might not be the case with folks who are closer to retirement and they don't want to kind of take on risky deals. So they would be looking at more like a more steady cash flow kind of deals where the returns may not be that great, but they're working with a very good operator and the returns are more steady. So that is one situation there with regard to how your phase in life becomes important in your investment decisions. And I've also seen other situations where there's a little or sometimes a lot of FOMO going on. I met a couple, both physicians, and they wanted to invest. And the husband has a medical office where both of them have their office spaces there. They have about 2 acres next to the medical office where he is thinking of expanding by building more medical offices and renting it out. And this is near the very good medical center in Texas. And that's what he's thinking. But his wife wants to buy a multifamily. And I asked them why, So we don't need to think that you need to be invested in a certain asset class to feel that, you are invested. So that is very important. It goes back to the why, right? I mean, why do you want to do this? So it's really good to think through that again. The next situation is your tax. And taxes are very important because they eat into your returns and your savings. And, you're working hard, but taxes are a drag. Sorry, we're saying something. Hey, Ravi, thanks for joining. So taxes are a big part of investments and tax planning. And finding investments that can be tax advantageous is key. So if you have a huge tax liability, then you need to really think about investments. And based on that, the investments could change, right? So your focus, maybe I take some more risk. And I've known physicians who are invested in opportunity zones where they're not really sure whether that would really take off. But then they think that the tax liability they can mitigate by being in a little more slightly riskier investment is worth the while. So again, these are very personal to your tax situation, and you need to talk with your CPA and get that expert opinion before jumping into any tax mitigation plans. But taxes are a critical thing in all this. The other situation is your risk tolerance. Can you lose money in investments? And it happens to everybody. If you've been in the investing world, everybody loses money. Maybe some less, some more, but even people like Warren Buffett lose money occasionally. So you need to understand how much of a risk can you take and how comfortable are you with that risk in terms of losing money? I mean, we should always think of a scenario where, hey, there could be some investments which do extremely well, and there will be some where we lose money. And how much money can you afford to lose? And also on a psychological and mental level, what is that dollar amount that will make you freak out, right? So for some people, it could be, hey, if I lose 100,000, I freak out. For somebody else, it might be, hey, if I lose 1 million or 10 million, only then I freak out, right? So that is the other piece to keep in mind. That is your risk tolerance part of it. And another piece here is your personality in terms from a money standpoint, right? Some people want more control over their money, right? And they're not comfortable letting others manage their money for them. So if I'm a person who is not comfortable with working with others, handing over money to others to manage, then I should be operating in that mode. I may be wanting to do something which is smaller, which I can handle and have more control over than handing money over to somebody else. Sorry about the background noise. That is my dog running around here. Sorry. So that is one part of the money personality. My wife, for instance, thinks that business is a crime, and so she had to be involved in any manner in any kind of business, which is fine. I mean, she's happy practicing medicine, which is fine. There's no right or wrong about this. It's just that people are different. Your money personality is different. Some people kill over money. Some people will die over money, right? So it's what it is. And then your values also come into play. And sometimes your values and your risk tolerance may be related too, right? I mean, if your values allow you to invest in a drug cartel, right? Some people do, right? They are running the drug cartel. But for some people, yeah, you don't want to be involved or investing in a drug cartel. And you also don't want to be killed in the process if something goes wrong. So those things come in as well. So we need to really think through all this and just understand yourself better as you start to invest. The next piece here is your external support system. So for instance, hey, somebody has a spouse who is a real estate agent, which is good. And he or she qualifies as a real estate professional while the other spouse is working full-time and as a physician, which is kind of where I am at right now. My wife is a physician who continues to practice while I'm a real estate professional for tax purposes. So that is a great situation to have from a tax standpoint. So that is one. There could be other situations where you have an external support system. That could be friends, it could be family who you can trust. It has its pros and cons when you have friends and family very closely involved in the business, because it could lead to conflicts, especially when things go south. So it's a delicate balance. But if things go well and reasonably well, then it's okay. It's what I think. I have a couple of scenarios where one of my nephews runs my land development and new single family developments in India. And it's worked out very well for me. I just get all the updates on WhatsApp. Everything is good. I just transfer the money. So I'm pretty much leveraging other people's time very effectively in that case. I also have another friend who runs a contract farming company, and they manage organic farms for me, which is not doing great, but not terribly bad either. So I'm okay with it. But it's a delicate dance. If things really go south, it can impact your relationship. So something to think about. So there could be other things from this angle, that is the owner and what your goals are, what you want out of investments, and all that. So it's good to think through that. So that's the first piece that we need to get under control.